Good morning. Welcome to our webinar on the COVID-19 stimulus packages. My name's Mark Molesworth. I'm a tax partner with BDO. And this morning, I'm just going to take 40 minutes or so of your time just to talk about the stimulus packages that have been announced, focusing very much on the federal stimulus packages, but also just touching very briefly on the sorts of things that the states are doing, but without going into the details of what every jurisdiction is going into. Clearly, these are uncertain times, and clearly the government has reacted to that. The government has been very focused on making sure, or attempting to make sure, that businesses in some shape or form can continue. And so that is very much the focus of the stimulus measures that we're going to be talking about this morning. Thank you for joining us, and without further ado, we'll get moving. The first stimulus measure that we need to talk about is the JobKeeper measure. Now, this is the big the big stimulus measure that has been put in place by the federal government. Over its 6-month period, the government is projecting that it will spend about $130 billion on the JobKeeper program. Now, to put that in context, the total tax take by all levels of government in a typical year in Australia is between $400 billion and $500 billion. So we're looking at an amount that is somewhere fairly close to a quarter of the total tax take of all levels of government being handed back in this one stimulus measure. So this is the one that has got most attention, unsurprisingly. The purpose of the JobKeeper payment is really that it's a social welfare program and it's being delivered via the tax system. So the administrator for this program is the Australian Tax Office, and the ATO has pulled out all the stops to attempt to deliver this program in the most efficient way possible. And by and large, they have been doing a good job. Where there are some bumps in the system, that is more to do with the design of the system, which the tax office isn't in control of, as opposed to the way that the tax office is attempting to implement it. So kudos where they're due. The tax office is doing a good job with this. When we're talking about the JobKeeper payment, we should really be thinking about it in two ways. The JobKeeper payment is partially a business subsidy. So for businesses that have been able to continue to operate, at least in some form, JobKeeper is partially a subsidy for them, subsidising their employees' wages up to $1,500 a fortnight. But the JobKeeper program is also partially an income support payment, or partially an income support program. And what it is where businesses have not been able to continue to employ staff, it ensures that $1,500 a fortnight goes from the government to the employer and into the staff's hands. So in a sense, the JobKeeper program is designed so that the employers are acting somewhat like Centrelink in relation to people who are not earning at least $1,500 a fortnight. So it's important when we're thinking about this program to understand that it is both of those things. It is both a business subsidy program and an income support program. And that explains to a large extent the design of the program. So the first thing that an employer needs to do if they think they may be eligible for JobKeeper is to work out whether they are in fact eligible. The eligibility test is all about measuring decline in turnover. So a business to be eligible has to show a decline in turnover of at least 30% between a month in the 2020 year or a quarter in the 2020 year and the same month or quarter in the previous financial year, in the 2019 year. So in order to become eligible for JobKeeper from day one, from the 30th of March, which was the first day of the JobKeeper program, then businesses have to be able to show a 30% decline in turnover in any one of 3 periods, and any one of those 3 will get you into the program. Those 3 periods are the month of March 2020 as compared to the month of March 2019, the month of April 2020 as compared to the month of April 2019, or the quarter from April to June 2020. So from the 1st of April through to the 30th of June 2020, the turnover in that period compared to the same quarter, April to June in 2019. As I said, the relevant threshold is a 30% or greater decline in turnover. Now, if your business happens to be part of a global group with more than $1 billion in turnover, then that threshold is 50%. So if your turnover in the global group is more than $1 billion in a year, you'll have to show a 50% decline in turnover, but in the same periods, in any one of those 3 periods. And if you're an ACNC registered charity, then the turnover decline that you have to show is only 15%. There are some discretions that the tax office has exercised to deal with atypical performance. So where, for example, the month of April 2019 is not a good comparison for the month of April 2020, or where the month of March 2019 is not a good comparison, and so on. That's particularly relevant where you have newly started businesses, so businesses that commenced after that period in 2019. But before the 1st of March 2020, because you have to have been in business on the 1st of March in order to be eligible. So for those sorts of businesses, for businesses that have undertaken acquisitions in the intervening period. So if you were in business in April 2019, but in the intervening period, you've bought another business, so that your turnover now compared to your turnover in April 2019 they're not really comparable periods. Then there are special rules that the tax office has issued for businesses in those circumstances. If you're in a drought or a natural disaster affected area, then there are special rules, again, because April 2019 or March 2019 or the June quarter in 2019 may not be a comparable period if you were affected by drought or natural disaster in that period. And also for businesses that are on a substantial growth trajectory. So businesses that have shown substantial increase in turnover between March 2019 and now, but then they've dropped off again, of course, because of COVID-19. There are some special rules for businesses in those circumstances. And if we think about technology startups and those sorts of businesses, they are the most likely to want to utilize that special rule. But otherwise, the basic rule is we have to compare this year, or the period in this year, to the period in last year. And interestingly, we have to compare that based upon our projections for what we're going to do this year. Now, clearly back at the 30th of March when this started, we didn't know what April was going to look like. And so we could use our projections for April 2020 in order to do the comparison to what actually happened in April 2019. Equally, if we're relying on the quarter, so from April to June 2020 as our test period, then we've had 1 month of that period, but we haven't had the other 2. We've still got 2 months left to go. And so clearly we have to project our likely turnover for that quarter and then compare that to what actually happened in that quarter in 2019. So it's all about those use of projections in these circumstances as opposed to actuals. And this is important because one of the questions that I'm fairly regularly asked about JobKeeper is, well, what happens if our actual results are better than our projections? So our projections were that we'd have a 35% decline in turnover, but our actuals end up better than that, and we can't actually show the 30% or greater decline in turnover when we actually come to look at it for real. And the answer is it doesn't matter. The answer is that JobKeeper eligibility is based upon your projections. And so as long as your projections are reasonable and you can document why they were reasonable when they were made, then that is sufficient to become eligible for JobKeeper. The fact that your actuals diverge from those projections, well, again, to start with, that's only to be expected. Projections are never 100% accurate, but in fact, they can be quite substantially inaccurate, and you can still be eligible for JobKeeper, because as long as your projections were reasonable at the time they were made, if something happens that you couldn't have foreseen, that doesn't matter. You remain eligible for JobKeeper. For anyone who has a group of entities where there is a special employment services entity which does nothing but employ the staff that are then used by the operating entities, then there are special rules for employment service entities. And if there is anyone in that situation, they should probably speak to their advisors, because the employment service entity rules are considerably more complex if you have to use them. So if you're in that situation where you have an employer entity and then several separate operating entities, the application of the JobKeeper test can be quite complex, and I'd encourage you to get advice in those circumstances. So once you've worked out that as an employer you're eligible, you then need to work out who your eligible employees are. So to be an eligible employee, a person has to have been employed by you at the 1st of March 2020, and they must remain employed. It doesn't matter if in between the 1st of March and the 30th of March you stood them down, or you even made them redundant and then subsequently rehired them. As long as they were actually employed at the 1st of March and they remain employed during the JobKeeper period, then they are eligible employees. It can apply to full-time, part-time, and casual employees, although for casual employees, they have to, the casual employees have to be able to show 12 months regular service. So you just need to be cautious with casual employees, because they will have to have been working for you on a fairly consistent roster for the last 12 months in order to be eligible. In order to be eligible, the employees have to be an Australian citizen, an Australian permanent resident, or the holder of some what are called some special category visas, which really more or less restricts eligibility to New Zealand citizens who are here with working rights. Other types of visa holders are generally not eligible. Again, if you have any doubt about that, that is something that you really should be looking to get particular advice on, because the area of visa holders and rights to work and eligibility for JobKeeper is a really complex one. But certainly all of your Australian citizens, permanent residents, and New Zealand citizens should be eligible. If an employee happens to have multiple employers, the employee has to nominate which of their employers they want to claim JobKeeper on their behalf. And the way that that's facilitated is that the system operates on a one-in, all-in basis. So if an employer says, yes, I'm eligible for JobKeeper and I want to take part, the employer is then obliged to notify every single one of their eligible employees of that fact that they're eligible and they are going to apply for JobKeeper, and provide each employee with a declaration which needs to be returned where the employee says, yes, I'm an eligible employee, I tick all those boxes, and I want to choose you to claim JobKeeper on my behalf. But you've got to send that out widely. Now, it doesn't make you ineligible if some of your employees say, no, actually, I don't want to be eligible for JobKeeper through you. So employees can opt out of the system, and that doesn't affect the employer's eligibility, but the employer must at least ask the question of every eligible employee. Just looking at sole traders and other businesses where the owner perhaps doesn't get paid a wage, these rules are called the eligible business participant rules. So business participants are eligible if they meet the at least 30% decline in turnover test. So that is not just sole traders though, it extends to individuals who happen to be partners in a partnership, or directors or shareholders in companies, or beneficiaries of trusts where those people are remunerated solely through distributions or dividends. If someone is an employee, they cannot also be an eligible business participant. So in other words, if you have an entity and you're employed by it, then you will be eligible as an employee. You don't have to worry about these rules, but if you're a sole trader or an individual member of a partnership, or the director of a company who only receives dividends, then potentially you can be nominated as an eligible business participant, and that business will then receive $1,500 a fortnight in respect of that eligible business participant. There's only allowed to be one eligible business participant per entity, so this is not extensive, shall we say. It's designed for small sole traders, mum and dad partnerships, private companies, where people may not have been drawing a wage, where they may not have been an employee. So what happens if we're eligible for JobKeeper? Well, the JobKeeper program entitles eligible employees to employers to $1,500 per eligible employee per fortnight. Now that is paid in arrears. So in other words, in relation to the first two JobKeeper fortnights, the fortnights commencing on the 30th of March and the 13th of April, the payment will be made in the first weeks of May, so about now, in relation to those fortnights. There is a requirement, though, that at least $1,500 per fortnight is then on-paid to those eligible employees. That payment is treated as assessable income to them, and it's subject to pay-as-you-go withholding. So therefore, after tax, looking at the fortnightly tax tables, that's about $1,300 a fortnight after tax. The gross payment is $1,500 a fortnight before tax. So the payment has to be passed on in full before tax. So we receive $1,500 from the government. I've then got to say, well, I'm going to pay at least $1,500 in wages to each eligible employee. And I'm going to withhold tax from that if I need to. Now, there's an interesting distinction here between what are wages for hours actually worked and what is the JobKeeper top-up, if you like. So if you have an employee who is continuing to work hours for you and is entitled based on those hours worked to more than $1,500 a fortnight, then everything they receive is in respect to wages. There is no top up. At the other extreme, where I have an employee who have stood down, they're working 0 hours for me, so they're not entitled to any remuneration as a result of actually working hours. If they're an eligible employee, I can claim JobKeeper for them. I'll receive the $1,500 from the government, and I have to pay the full $1,500 gross before tax. I then withhold tax from it, but I have to pay on the full amount to the employee. And that's all top up. The entire amount paid to the employee is top up. Now, there's also a middle case where I've got someone who's working maybe a couple of shifts a week for me, which entitles them to say $1,000 in the fortnight. What I have to do, they're still eligible. I receive $1,500 from the government. I have to make sure they receive at least $1,500 gross. The $1,000 is wages for hours worked, and there's a $500 top up. The importance of distinguishing between what is wages for hours worked and what is top up is particularly relevant to superannuation guarantee, because you continue to have superannuation guarantee obligations in respect of in respect of the wages that you pay to people for hours worked, but you don't have superannuation guarantee obligations in respect to any top up amount. Now, if I can show that visually, I've got 3 employees here, Alice, Bob, and Clarice. Alice is working hours for me, which entitles her to $2,000 a fortnight. So I can claim JobKeeper in respect of Alice. That comes into the business, and it works as a subsidy for Alice's wages in effect. I receive the $1,500 and I'm paying her $2,000 a fortnight. I meet my obligations under the JobKeeper rules. At the other end of the table, Clarice has been stood down. We've got no work for her. She's an eligible employee. I receive $1,500 a fortnight from the government in respect of her, and I have to pay her gross $1,500 a fortnight, and it's all top up. It's all JobKeeper payment, and therefore the entire amount's not subject to super guarantee charge. Bob in the middle is sort of the mid case. He's working enough hours so that he is entitled to $1,000 a fortnight. He's eligible for JobKeeper, or he's an eligible employee for me in respect of JobKeeper. So I receive $1,500 from the government. I pay him his $1,000 in wages, and I have to pay him a $500 top up out of the JobKeeper money. So in Bob's case, the $1,500 I received from the government is partially top up, which gets passed straight through, and partially a subsidy for the work that Bob's actually doing for me. So the timeline in respect of JobKeeper is that it's going to be paid to you in arrears. That means you're going to have to pay the employees first. payment to those employees for the first 3 fortnights, so that's the 2 fortnights in April and the first fortnight of May, is theoretically, or is not theoretically, is actually due by this Friday. So if we're participating in the scheme and we need to make payments to the employees, I've got a transitional period in respect of the 2 fortnights in April where I'm able to pay any time up to the 8th of May and still be eligible. But for this fortnight that we're standing in at the moment, which is the fortnight that commenced on the 27th of April and is due to finish on the 10th of May, I actually have to pay everybody, every eligible employee, at least $1,500 a fortnight inside the fortnight in order to continue to be eligible. So what that means is effectively payment for the first 3 fortnights, if we haven't already made it, is due by this Friday. The reimbursement from the government of the first 2 fortnights is we have to put in a claim form for it. And we have to put in that claim form before the 31st of May, and then we will get paid by the government. It seems to be within about 48 hours of having put in the claim form. So in terms of claiming from the tax office, there's a 2-step process. The first is that as an employer, you have to enroll, and it's called an enrollment form. So you enroll yourself as an eligible employer. And then as a second step, a separate form, it's all done online. I use the word form, but it's all done online. We have to nominate who our eligible employees are and then make a claim in respect of them. And so if we follow that 2-step process, we enroll, we then nominate employees and make the claim. What happens is after we make the claim monthly in arrears, and the government pays us. So the government will pay us if we make a claim today for the first 2 JobKeeper fortnights, the first 2 fortnights in April, and we should be paid that money probably within 48 hours of lodging the claim form. It might be longer. I can't guarantee what the tax office will do, but at the moment the payments seem to be running on about that time frame. So if you haven't already done it, the next step will be to enroll with the tax office, and we would suggest you do that as soon as possible. We'd also suggest that you take industrial relations advice, so employment law advice, because there are more things to think about if we're going to put employees that we might have on stand down, or we might be looking to rehire or re-employ employees that we've already made redundant or already let go. We need employment law advice about that. There are more things than just JobKeeper to take into account there. We have to then tell our employees that we think that we are eligible, and that we'd like them to, if they wanted to, nominate us as to be their JobKeeper recipient. We have to make sure the employees are all paid at least $1,500 a fortnight by the 8th of May, and then we have to lodge a claim. The last point on this slide is important. We need to be careful about anti-avoidance provisions. There are some serious anti-avoidance provisions with large teeth in them in respect of the JobKeeper program. So what that means is that if you change what you otherwise would do, if you you say, well, I need to show a 30% decline in turnover for April, so therefore I'm just not going to bill anyone in April. I'll still continue to provide services, but I just won't bill them. That would fall foul of the anti-avoidance provisions. So if you're doing something that you wouldn't otherwise do simply, solely, or for the dominant purpose of obtaining the JobKeeper payment, then the anti-avoidance provisions will be there to get you. And the tax office is saying that they are trying to be very helpful for businesses who are eligible for JobKeeper, but they're also trying to be very unhelpful for people who attempt to put themselves in a position where they get JobKeeper where they shouldn't be or wouldn't otherwise be eligible for it. So just be aware of the anti-avoidance provisions if somebody comes to you with a scheme to get JobKeeper which is too good to be true, because schemes that are too good to be true normally are. All right, so to continue on with the federal government's schemes that are there to support businesses, this one flies under the radar a little bit, but the cash boost for business is actually starting to operate, and we're starting to see cash flow to businesses from this stimulus program. So how the cash boost for business works is that if you're an employer with an aggregated turnover of less than $50 million, so that's you plus all of your connected entities, all of your commonly controlled entities. So if you're turning over less than $50 million, then you're eligible. And what happens is that as you lodge your March business activity statement, you end up receiving the first of two possible cash flow boosts. And the minimum cash flow boost you can possibly be entitled to is $10,000, and the maximum first cash flow boost you can receive is a maximum of $50,000. And the way this works is that effectively it looks at what you've lodged on your business activity statement for March in terms of pay-as-you-go withholding. So the amounts withheld from wages paid to your employees. And it says, well, if that amount's less than $10,000, we'll pay you $10,000. If it's more than $50,000, we'll pay you $50,000. If it's somewhere in between, then we'll potentially pay you that amount in between. And then as you lodge future BASs out to 30 June, we might pay you a bit more as part of this first boost. If you haven't already maxed out your boost, we'll pay you more until you max out the boost at $50,000. And then if you're eligible for the first boost, you're automatically eligible for the second boost, which is the same amount in dollar terms as the first boost, and it's paid equally over June, July, August, and September. So the maximum cash flow boost that you can get adding together the first boost and the second boost is $100,000, because if I'm entitled to $50,000 in the first boost, I'm automatically entitled to $50,000 in the second boost. So the way that this works is a little bit complex. I'll give you a couple of examples to try and give you the examples. But I guess unlike JobKeeper, this program is being administered automatically by the tax office. So if the tax office considers you to be eligible, they're automatically paying these amounts, and we don't have to make a claim, we don't have to do calculations. It is just happening, and we are starting to see the cash boosts flow from the tax office as we speak. So for example, if you're a small withholder, so you're sending off your withholding to the tax office every quarter, if on the March BAS you declare $6,000 as pay-as-you-go withholding, and on the June BAS you declare $5,000 of pay-as-you-go withholding, then your first boost is equal to $11,000. It's the combination of those two numbers. Interestingly, it's payable $10,000 on lodgement of the March BAS because that's the minimum payment. So you automatically get up to 10. And then the final one is payable on lodgement of the June BAS. So you'll get $11,000 in the first boost, and then the second boost will be $11,000 also. It's exactly equal to the first boost, and it'll be payable $5,500 a time in July and October. It gets slightly more complex for medium or large withholders, so bear with me here. But for example, you can see the PAYG withholding profile for this business, where it's declared pay-as-you-go withholding on the March BAS of 11,000, April 7, May 7, June 7. So the first boost will be $50,000. It's going to be calculated in an interesting way, though. The way that the first boost is calculated is that this business will receive $33,000 on lodgement of the March BAS, which is 3 times the amount of the pay-as-you-go withholding on the March BAS. It will then receive $7,000 on lodgement of the April BAS because $7,000 is what was declared as pay-as-you-go withholding. Another $7,000 on lodgement of the May activity statement because that was what was declared as withholding. And then the final $3,000, because we've maxed out here at 50, the final $3,000 on lodgement of the June BAS. And then the second boost payment that this business will be entitled to will be $50,000, exactly the same amount as the first boost, and it'll be payable in 4 equal installments, $12,500 in each of July, August, September, and October. And so in this way, this business will receive a total cash boost across the first and second of the maximum of $100,000. Now, there's probably a couple of issues that you need to be aware of in relation to cash boost. As I say, it's an automatically operating program. There is no requirement to make a claim. The first issue is that although it's called the cash boost, it's not necessarily cash. What the way the cash boost is dealt with is that it's offset against your running balance account with the tax office. So your running balance account is the account into which all of your tax liabilities fall and which you then pay against. So if you're in the situation where that running balance account goes into debit, so that the tax office actually owes you money, then they will refund it to you. But otherwise, it will offset against your liabilities. So your liability for GST, your liability for pay-as-you-go withholding, and so on. So it will reduce the amount that you have to pay to the tax office, but it may not necessarily turn into cash in your pocket, unless, as I say, your running balance account happens to go into the situation where the tax office actually physically owes you money. The other thing is, to be eligible for the cash boost, you need to have made some sort of lodgement between the 1st of July 2018 and the 12th of March 2020 in respect to the 2019 year. Now, that shouldn't be too hard for most businesses because they will have lodged business activity statements or an income tax return or something like that in that period. However, it is possible that there are some businesses who've been tardy who may not have made those lodgements. Those businesses potentially will miss out on the cash boost. So it is important, as always, to keep your lodgements up to date. And the cash boost is only payable once you lodge the relevant activity statements anyway. So there is a big incentive to start lodging those activity statements in order to make yourself eligible for the cash boost. All right, so there are a couple of stimulus measures that deal into the depreciation regime in the federal sphere. The first of these is an instant asset write-off. So this incentive is already in place, but some of the goalposts have been moved. So at the moment, there is an instant asset write-off for assets costing less than $30,000. That has, since the 12th of March, been changed to be up for assets costing up to $150,000. And the aggregated turnover for businesses who can claim the instant asset write-off has moved from $50 million to $500 million. So in other words, quite large businesses can now take advantage of this instant asset write-off. So this applies for any asset that you install or have, that you first use or have installed ready for use between the 12th of March 2020 and the 30th of June 2020. So it's quite a short 3.5 month window. But if you are in the situation where you're considering asset purchases and you fall within these categories, what this stimulus measure allows is for the whole cost of the asset to be written off for tax purposes in the 2020 year. So the whole amount will become deductible. The whole cost of the asset will become deductible in the 2020 year. Now, if for some reason you're not eligible for that instant asset write-off, there is another stimulus measure which has been referred to as the business investment incentive. In effect, I call it the 50% instant asset write-off because that's what it allows for. So if you're eligible for the business investment incentive, you get to claim in the year in which you first use the asset 50% of its cost. So rather than the instant asset write-off being 100% of its cost, you get to claim 50% of its cost in year one, and then you get to depreciate the other 50% ordinarily as you would over the life of the asset. Again, you need to have an aggregated turnover of less than $500 million in order to be eligible for the business investment incentive, but there is no cap on the value of the asset. So in other words, this investment incentive can apply to an asset of any value. The timing is slightly different to the instant asset write-off also. The asset has to first be used or installed ready for use between the 12th of March 2020, so that's the same, but the end date is the 30th of June 2021. So it spans into next financial year as well. It's got to be a new asset, so totally new asset, and you can't have had a contract to buy it or a contract to construct it in place before the 12th of March 2020. So in other words, it's got to be a new decision that you've made after the 12th of March 2020 to buy or construct this asset. And the final thing, which is not a big issue for most businesses, is that the asset has to be for use principally in Australia in a business. So you've got to be looking to use it onshore. But in those circumstances, for an asset without where there's no cap on the value of the asset, this could be quite an incentive for some businesses who actually have the money to spend in order to stimulate the economy, who are looking at new assets and think, actually, I am going to go out and buy an asset in these circumstances. There are some other federal measures that we just want to touch on really briefly. There is the Apprentices and Trainees Reimbursement Scheme. So this is for businesses with fewer than 20 employees. Where you have an apprentice or trainee, the government will reimburse you 50% of their wages from between the 1st of January 2020 to 30th September 2020. Now, if you're in that situation and you're also eligible for JobKeeper, then JobKeeper overrules the Apprentices and Trainees Reimbursement Scheme. So in other words, the reimbursement scheme will apply from the 1st of January 2020 up until the 31st of March, and then from April onwards, those apprentices and wages will be eligible, if they're eligible for JobKeeper, you'll instead get a JobKeeper payment for them. This reimbursement scheme is also available to large businesses, so businesses with more than 20 employees, if they re-employ an apprentice or trainee who's been sacked by a small business. So in other words, if the apprentice would have been eligible had they continued to be employed, then a large business can get the reimbursement for if they then employ that apprentice or trainee. You will have seen a lot of press about early access to superannuation. The rules have been changed so that eligible individuals can access up to $10,000 from their superannuation before the 30th of June, and then a further $10,000 after the 30th of June if they feel that they need it. In order to be eligible, you've got to show that you've had at least a 20% reduction in your income or in your hours of work. But if you can show that, then you do have the ability to access superannuation. Now, whether that's a good idea or not in terms of the rest of your career planning and in your retirement planning is, of course, a different question. But clearly, if you're desperately in need of cash, this is a way that you can get access to some of it. The federal government has also announced a government guarantee scheme for loans. So this is for loans, they have to be taken out through the commercial banks. This is not a loan that you go and apply to the government for. This is a loan that you apply to your current banking relationship for. But the government says that it will guarantee up to, or half of, up to $250,000. So what that means is that the bank should be somewhat less reluctant to lend because they know that they're 50% guaranteed by the government on loans on new loans up to $250,000. The tax office is also providing help. So the tax office is quite happy to talk to businesses about deferring tax liabilities, particularly income tax, fringe benefits tax, and excise, if anyone on this call pays excise, which is highly unlikely, but certainly in respect of income tax and FBT. They are also relatively willing to talk about deferring the payment of GST, although their commentary on their website has changed substantially between March and now, where originally they were saying that they were very happy to defer the payment of GST, and now they're a bit more reluctant. But if you require deferrals of those sorts of taxes, income tax, fringe benefits tax, GST, and so forth, my best advice to you is to lodge the document. Make sure you lodge the business activity statement. Don't be afraid of that, so that the liability can at least be recognised. And then talk to the tax office about deferring that liability, because it's much easier to have a discussion with the tax office about, yes, I know I have that liability and I want to enter into a payment plan, as opposed to I'm just going to stick my head in the sand and not even lodge the documents and not admit that I've got the liability. The final tax there, pay-as-you-go withholding, which is the withholding from employees' wages, is always a bit more tricky. Because in effect, that is part of the employee's salary. And so the tax office sees that as somebody else's money, and they're much less likely to agree to you deferring pay-as-you-go withholding. However, if you're in dire straits, it is still worth asking. It's still worth having that conversation. The tax office has also pointed out that you can vary your pay-as-you-go installments. Now, these are the monthly or quarterly installments that companies and sole traders make towards their tax liabilities. You are able to vary them. You can vary them to nil, and in fact, if necessary, you can, if you've overpaid your tax, you can get a refund of prior quarter or month's pay-as-you-go installments. And so those that could be a source of cash for some businesses if they were trading okay up until March, but now they're going to make losses through the rest of the year. It is possible where you have been paying tax installments potentially to get them back. And so that could be a source of funding for some businesses. The states and territories, as I said, because there are 8 different jurisdictions, I don't intend to waste everybody's time by rolling through every one of those 8 this morning. I think we'd all go to sleep. But there are many different measures from each of the states and territories. They generally fall into 3 categories. The first is that states and territories are offering payroll tax relief. So that varies from straight out holidays from payroll tax, so you don't have to pay payroll tax, through to deferrals of the liability to pay payroll tax until either later this year or even early 2021. So have a look, if you are paying payroll tax, have a look at what your state or territory authority can do for you in respect of that, because some of those schemes are quite generous. Some of the states and territories are also running grants and loans schemes. So in other words, you can apply to the state or territory government directly, and this isn't through banks, this is directly to the government, and ask them to provide you with a business survival grant or a business survival loan. And the terms of those grants and loans are often quite beneficial. Certainly the Queensland government loan scheme, for example, provides you with a loan of up to $250,000 interest-free for 12 months, and then at a very low interest rate after that. So where those schemes are available, and I know the Queensland loan scheme has actually been shut down in the last few days because it was oversubscribed, but keep looking out for those grants and loan schemes. They are worthwhile keeping your eye on. And then finally, there are states and territories, and indeed local governments, are either waiving or deferring many fees and charges. So where the government would normally charge you something for registering a document or doing something, there are a number of circumstances where the governments are saying that you don't have to pay us those fees and charges, or they're deferring the payment of those fees and charges. So again, it's worthwhile asking, if the government is going to charge you something, it's worthwhile asking the question, do I actually have to pay this right now? Or is there a scheme which would allow it to be either deferred or waived entirely? So what now? Where are we going? There's a huge amount of information out there about these stimulus measures, particularly JobKeeper. Some of it is good, some of it is less good. I would suggest that you rely on reputable sources of information in relation to all of these schemes. The ATO website is very good. It has huge amounts of information, almost to the point of information overload. But if you're willing to sit down and take the time, it has a huge amount of really good information on it about all of these schemes that are being administered by the tax office. The Department of Treasury website was very good in the early days. It's really been overtaken by the tax office website now. And each of the state and territory revenue authorities, and indeed each of the state and territory governments, all have dedicated COVID-19 web pages, and they are worthwhile looking at to get information not just about the stimulus measures, but also about information about the current social distancing guidelines and what is necessary, and information about when a business might be able to get back to operating with some sort of normality. My advice to everybody in these difficult times is always to work out what you know versus what you are assuming. And it's, you can really only act on what you know. Your assumptions might be valid, they might not. Clearly, if you can discuss that with your advisors, you will put yourself in the best position to make good decisions. But you have to focus on what you know. And finally, my last piece of advice is talk to your supply chain, and I mean your supply chain both ways. Talk to those who are supplying things to you in terms of goods or services, premises, all of those sorts of things. Talk to them about how they're going, and how you can help each other come through these difficult times, but also talk to the people that you're supplying to. Talk to your customers, work out how they're going, try and work out how you can help them and they can help you survive through these difficult times. Other than that, I am done. I promised 45 minutes and I've hit it almost exactly. If you have questions, my contact details are on the scheme. Alternatively, the bdo.com.au website has a large amount of information on it and contact details for professionals who will be able to help you in your local area. Please feel free to get in contact if you think we can help. Thank you for your time, and please stay safe and have a lovely day.